As of today, Sunday, May 10, 2026, the stock market is currently closed. Nokia stock ended the last trading session on Friday, May 8, 2026, at a price of $12.82 per share. This marked a solid move for the day, with the stock climbing 0.47 or roughly 3.81% during regular trading hours. While most investors are conditioned to think of Nokia as a legacy hardware play or a forgotten giant of the mobile phone world, the reality unfolding on the tape tells a completely different story. Most people assume that telecommunications infrastructure is a slow, cyclical business with tight margins and even tighter competition, but Nokia has effectively positioned itself at the center of the hardware demand spike for data centers and high-capacity networking. This latest price action is part of a much larger trend where the market is finally re-rating the company based on its role in the optical networking space. While everyone was busy watching high-flying semiconductor names, Nokia quietly began capturing massive orders from cloud providers who are desperate for the plumbing that makes high-speed data transfer possible. The expectation was that 5G spending would cool off and leave a hole in Nokia's revenue, but the reality is that their network infrastructure division is seeing growth that would have seemed impossible 2 years ago. Specifically, their optical networks business is up significantly because the same companies buying GPUs are finding that their existing fiber and routing systems simply can't handle the traffic. If you look at the recent trading volume, it is clear that institutional players are starting to move back into this name. We saw a massive spike in options activity recently, where the volume nearly tripled its daily average. This kind of movement usually suggests that big money is positioning for a shift in the fundamental narrative. People often use tools like Schwab Intelligent Portfolios or various online investing sites to find stable dividend payers, and Nokia has traditionally fit that mold. However, the current volatility and upward momentum suggests it is behaving more like a growth stock than a utility-style telecom provider. Whether you are using the Robinhood app for quick trades or managing a complex portfolio through interactive brokerage trading platforms, the movement in Nokia is hard to ignore. Many retail investors who engage in self-investing often overlook these European giants because the growth seems capped, but the shift toward AI-native networks has changed the math. The general belief is that Nokia is just waiting around for 6G to happen in 2030, but the deeper analysis shows they are already deploying software-driven platforms that optimize current 5G radio access for the workloads of today. Most analysts had a neutral outlook on the company heading into 2026, but the Q1 results proved that the pivot toward higher-margin products is working. The company reported a significant jump in sales to cloud and AI customers, which now represents a growing portion of their total business. This is a massive departure from the old model of relying solely on service providers like AT&T or Verizon for revenue. By selling directly to web-scale players and hyperscalers, Nokia is bypassing some of the traditional bottlenecks of the telecom industry. The institutional activity we are seeing on platforms like Fidelity and through Fidelity brokerage accounts suggests a renewed interest in Nokia's financial health. With nearly $4 billion in net cash on the balance sheet, the company has the firepower to continue its aggressive acquisition strategy, much like it did with Infinera to bolster its optical capabilities. This financial strength is a key reason why the stock has outperformed its peers over the last 12 months. While the industry average for telecom equipment was up, Nokia's gains were more than double that, showing a clear divergence in performance. When you look at the daily swings we've seen throughout May, the stock has been respecting key technical levels that indicate a bullish bias. The recent earnings reaction was a classic example of the tension between what the market thinks will happen and what actually happens. The market expected a miss due to softness in mobile infrastructure spending in certain regions, but the reality was a beat on the bottom line, driven by massive cost efficiencies and a better product mix. This is where the curiosity loop for investors really begins. If Nokia can grow its earnings while its primary market is supposedly in a slump, what happens when that market eventually recovers? The sector momentum is also working in its favor. As more investors look for backdoor ways to play the infrastructure boom, companies like Nokia that provide the essential routing and switching gear become more attractive. If you are doing your own investment help research or looking through investing sites for long-term holds, you'll notice that Nokia's dividend yield, while modest, is backed by very strong free cash flow. This makes it a rare breed in the current market, a company with a growing tech-heavy revenue stream that still pays you to wait. I want to hear from you on this. Comment below how many shares of Nokia stock you currently hold, or if you are planning to add more at these levels. Do you think the shift toward AI-native 6G networks will be the catalyst that finally pushes this stock back toward its all-time highs, or is the competition from other global players too stiff? Your perspective helps us get a better sense of what the retail community is actually thinking versus what the institutional reports are saying. Looking at the business model specifically, Nokia has transitioned into a software and licensing powerhouse. They hold a massive portfolio of patents that generate high-margin recurring revenue. This is the part of the company that many people forget exists. Every time a 5G phone is sold, there is a good chance Nokia is getting a piece of that transaction. This licensing revenue provides a floor for the stock, allowing them to reinvest in R&D without blowing out their expenses. Their recent work with NVIDIA on AI RAN technology is a perfect example of this. They aren't just building towers anymore. They are building intelligent platforms that can adjust to traffic demands in real time. For those using SoFi Invest or SoFi Active Investing, the allure of Nokia often lies in its valuation. Even after the recent run-up, it still trades at a multiple that looks reasonable compared to some of its North American rivals. This valuation gap is starting to close as the market recognizes that Nokia's tech stack is just as advanced, if not more so, in certain optical and IP segments. The integration of high-performance end-to-end networks is a complex task, and there are only a handful of companies globally that can do it at scale. If we look back at the historical performance, Nokia has had its share of ups and downs, but the reset, accelerate, and scale plan introduced by management a few years ago is clearly in the scale phase now. They have moved past the structural issues that plagued them in the early 5G days and are now leading the charge in Open RAN products. This allows their customers to move away from rigid legacy models toward more flexible, demand-driven operations. This isn't just about connectivity, it's about giving enterprises the tools to manage massive amounts of data at the edge of the network. The future outlook remains tied to how quickly these new technologies move from validation to commercial deployment. We are seeing real-world trials of AI-ready networks already, and the roadmap toward 2027 and 2030 looks incredibly robust. The risks, of course, include macroeconomic pressures and potential semiconductor supply constraints, which management has been very vocal about. However, the order books are filling up, and the book-to-bill ratio is staying healthy, which provides a level of visibility that many other tech companies currently lack. Whether you are using the Fidelity mobile app to check your balance or executing trades on the Robinhood trading platform, understanding the nuance of Nokia's transition is vital. It is no longer just a phone company that failed to keep up. It is a vital part of the global internet backbone. The reality of their current growth in AI and cloud segments has completely bypassed the old expectations of a stagnant telecom giant. In summary, the story of Nokia in 2026 is one of a quiet transformation that is finally being reflected in the stock price. The expectations were for a slow, dividend-focused laggard, but the reality is a lean, tech-driven leader in the optical and IP networking space. By focusing on high-margin vertical markets like energy, transportation, and large-scale web players, they have diversified their revenue and protected their margins. The surge in institutional interest and the massive uptick in options volume are clear signals that the market is waking up to this new reality. As we move forward, the focus will stay on their ability to execute on the AI RAN transition and maintain their lead in 5G advanced technology. The authority with which Nokia is now operating in the data center space suggests that the recent price appreciation might just be the beginning of a much larger revaluation. Keep a close eye on those daily trading volumes and institutional movements through your individual brokerage accounts, as they will be the primary indicators of where this trend goes next. The gap between what people believe about Nokia and what Nokia is actually doing is where the real opportunity lies for the informed investor. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.